All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using a life insurance policy, you've come to the right place. So be sure to subscribe to this channel and give this video a like so that you're notified whenever I come out with new videos. Today, we're digging back into the Double Play archives again. I found an old video that I had not edited. So today we're going to be talking about understanding Index Universal Life. And this one was shot about almost 4 years ago. And I really wish I would have gotten it out there because this covers a lot of important points, things that people really need to understand about Index Universal Life. So the key points that I really want to get across in this video are that indexed universal life and whole life work very much alike. You know, if somebody tells you that they're different or whole life is better or indexed universal life is better, they don't understand how life insurance works. They're simply repeating what they've been told once before. So in this video, I'm going to go into how much they're alike and how they work the same. I'll cover the subtle little differences in how they work. And then when it comes to the double play, I'm going to show you exactly why I think that the Index Universal Life is actually a little bit better product for investing in real estate or any kind of private banking strategy like the infinite banking strategy, bank on yourself, anything like that. Again, anybody who tells you that those things have to be done with whole life, they sell whole life, and that's just not the case. All life insurance policies allow for private banking strategies. So sit tight through the introduction, and I will get the 4-year-ago me is going to get started telling you about Index Universal Life. All right, so let's get started. So again, today we're going to be talking about Indexed Universal Life. And what I want to do is start off by giving you some of the insurance fundamentals and just explain how an Indexed Universal Life policy is no different from any other life insurance policy out there. And once we've covered the similarities, then we'll look at the differences. What makes the Indexed Universal Life superior, in my view, to a whole life, and why I think it's better for the double play and for life insurance retirement plans for that matter. So since we're going to be diving down into the weeds, if you're not familiar with life insurance, permanent life insurance, if you're struggling with understanding what the cash value of a life insurance policy represents, guarantees, minimum versus maximum overfunded life insurance, go down to the description box right now, and there's a link to my website where you can download a free copy of my Life Insurance 101 ebook. And I'm also going to put up a link to the Life Insurance 101 video that I did. So if you're weak on the fundamentals, go ahead and pause this video and go out and listen to the Life Insurance 101 or read that paper and then pick it up again where we left off. But nonetheless, I do want to start with a basic understanding of life insurance. All right, so let's get started. One of the key takeaways that I want you to get from this video, I want you to understand that all life insurance works the same way. But given that the interest crediting strategies employed in an Index Universal Life will allow the cash value to capture some of the equity premium, the cash value in an Indexed Universal Life should perform better than the cash value in a similarly designed whole life policy. So how are we going to attack this today? So first off, I want to talk a little bit about Life Insurance 101. I just want to make sure that everybody has a good grasp of the fundamentals of a life insurance policy and what the cash value of a policy represents. Then we're going to spend some time talking about the similarities between whole life and Indexed Universal Life. And then we're going to look at the differences and what makes an IUL unique, and why I believe that the way the interest crediting works on an Indexed Universal Life, the cash value will grow at a superior rate, thus making it better for the double play. So this is our familiar graph of a minimally funded life insurance policy. So this is the policy that if you called up a life insurance agent and asked for a quote on $1 million death benefit, the insurance agent is going to quote you the lowest possible premium that you can pay to get that $1 million death benefit, because they know that you're going to go out and shop it around to other insurance companies. So these policies typically collect as little premium as possible to perform on the obligations of the policy. And what I want you to understand about life insurance, and I think this is probably the simplest explanation of whole life or life insurance that you'll ever hear. The cash value is literally the policy owner saving up the death benefit for the insured over the insured's lifetime. Now, you'll hear some complicated explanations that it's a savings component and this and that, but just understand, it's literally the policy owner saving up the death benefit on the insured over the insured's lifetime. So if the insurance company makes some really conservative growth rate assumption, they can basically back into how much premium they need to collect in order for you to save up your own death benefit. In the background, of course, they've also got to collect a little bit more because there is the risk that you could die before your actual life expectancy. So there's two parts of every life insurance policy. There's the savings component, which is the cash value, you saving up your own death benefit, and then there's the mortality risk. So the insurance company simply needs to collect a little bit extra, or they take it from the cash value, to pool to pay the expected claims. So if we look at this graph, at the very beginning, there's a ton of risk to the insurance company. There's almost zero cash value and $1 million death benefit. Now, luckily, 45-year-olds typically make it to 46, but some get sick, some get in accidents, so they need to account for the few claims that they're going to pay. So they need to collect resources, pool them, to pay the expected claims each year. Now, as you can see here, by the time we get out to age 79, the client has saved about 50% of the death benefit. The death benefit is $1 million. You've got about $500,000 of cash value. So the insurance company now only needs to pool enough to cover $500,000 of net risk on their part. And you can see that that net risk gets smaller and smaller every year, which brings us to the key takeaway that I want before we move on. I want you to understand that the insurance company has an incentive for the cash value to grow as quickly as possible and as safely as possible. So insurance companies all, for the most part, invest in the exact same asset classes that we'll see here as we get on to the next slide. So I went online and I looked at the annual report for one of the top performing whole life companies, MassMutual. As of the time that this video is being produced, they're paying a dividend of over 6%. So I wanted to take a look at what they're investing in so that they can pay a 6% dividend. And this is their asset allocation coming from their 2018 annual report. And you can see that the top asset classes are bonds and mortgages, followed by policy loans. But if we add up the numbers in the bond and mortgage category, we find that their asset allocations to bonds and mortgages is about 71.6%, with the remainder of their assets being spread across other asset classes. They've got some real estate, they've got some equity. A big chunk of their assets is in policy loans to their own policy owners. Remember, a policy loan is a loan from the insurance company that's secured by your cash value. This is looking at the policy loan from the other perspective. This is the money that they loaned to their policy owners that they're going to receive back someday. So they're earning a rate of return on these assets. All right, so now let's look at the asset allocation for a company that's well known for Index Universal Life. So this data comes from the annual report for Securian, which is also Minnesota Life. And as you can see, they invest in pretty much the same asset classes, bonds, mortgages, and other securities, but with the heaviest allocation being on bonds and mortgages. But what I want you to do now is take a look at the allocation to bonds and mortgages. where Minnesota Life had 71.6% in those categories, Minnesota Life has 90% of their assets in bonds and mortgages, with the remainder spread across what they call other investments. So if the underlying assets for a company that's focused on the IUL market is actually much more conservative than that for a whole life company, then how can it be that Index Universal Life can outperform a whole life? So the key difference between a whole life and an Index Universal Life comes in the way that the interest that they earn is credited to the cash value of the policies. In the case of a whole life, the interest that they earn on their assets is paid to the policies in the form of a dividend. In an Indexed Universal Life, on the other hand, they actually take the interest that they earn on their assets and they go out to the index options markets with one simple goal: to capture as much movement in the market index as they can get with the money that they have. To capture as much movement in the market as they can get with the money that they have. So this brings us to some of the key terms in an Index Universal Life: caps and floors. So the cap represents the maximum amount of movement that the hedgers can capture with the money that they have. So in today's market, we're seeing caps of below 10% now. And the reason that the caps are so low is that that's the most amount of movement that they could capture with the money that they have. Where does the money come from? It's the interest that they earned on their portfolio of investments. And with interest rates dropping to historic lows right now, the insurance companies simply have less money with which to purchase options. But one thing that I find interesting is that if we take the current low caps and we apply that new cap to the changes in the S&P 500 index over the last 30 years, I still calculate an average annualized return of over 6%. So in a market where the Moody's Corporate Bond Index average is about 3.5% right now, the expected rate of return, if we did a look back for the last 30 years of market changes, would be over 6%. So they're literally, even with today's low cap rates, they're still able to capture about a 2% premium over what they would have been able to pay if they credited that interest to the policy as a dividend. In past years, when interest rates were higher, the cap rates were higher, and when you apply those higher cap rates to the same changes in the market over the last 30 years, you come up with a higher expected rate of return. But remember what I said earlier, the goal of an Indexed Universal Life is not to capture the equity market. A lot of people get disappointed when the cap rates change, that they go down, because they think that they're going to earn a lower rate of return. But I want you to understand the insurance company's goal is not to capture the equity market rate of return. It's simply to beat the debt market rate of return. So whether we're looking at a high interest rate climate or a low interest rate climate, they're still capturing some premium over that rate that they would have paid to the policy had they simply taken the interest and credited it to the policy's cash value. The key point here is that the Indexed Universal Life will still outperform a whole life, whether the interest rate climate is low or high. So understand that if the insurance company took the interest that they would have otherwise paid to your cash value and they spent it on options, that's where the cap and floor comes from. The movement to the upside is the cap. That's the most movement that they could capture with the money they have. And if the index falls, the options expire worthless. And all you lost was the interest that you would have otherwise earned if they would have paid the interest to the cash value as a dividend. So let's talk about participation rates. The participation rate is simple. It's the percentage change in the market that you're going to get for a given strategy. Now, typically, a 1 year point-to-point change in the market of the S&P 500 is usually 100% participation. If the market goes up 10.5, you get 10.5. If the market goes up 5, you get 5. But there are other strategies. A good example would be uncapped strategies that have no cap. these are typically limited or hedged by the participation rate. So you might have a product with a 75% participation rate. So if the market goes up 10, you get 7.5. So hopefully that's easy to understand. The next one is the multiplier. And multipliers are kind of unique because so far what I said was that the insurance companies take the interest that they earn and go to the options market with the goal of buying as much movement in the market as they can get with the money that they have. But what if they backed off and bought more options but at a lower strike price? So you might have a lower cap rate offered, but you might have a higher multiplier. So you might get 140% of any change in the market index. Market goes up 10, you get 14. Market goes up 1, you get 1.4. Market goes up 2, you get 2.8, and so on. Strategies like these are great when you're using an index universal life for a life insurance retirement plan. You know, once you're retired and you're taking income from your cash value, borrowing against it, zero is not your friend. If the market were to fall and your cash value earns a zero in the same year that you're paying interest on a loan, that's a bad thing. But these strategies with multipliers allow a small movement in the market to be multiplied. And it can't help against a 0 year, but it can certainly translate a small return into a bigger return, which is helpful when you're doing a life insurance retirement plan. All right, and lastly, I want to talk about guarantees. For all practical purposes, there is no guarantee on an index universal life. There is a guarantee, but it will never ever be triggered for you. And let me tell you why. Understand the basic mechanics of an index universal life. If you've got a floor of 0 and a cap of 10, if the market declines, you're going to get 0. It's not going to pay some guaranteed rate. This is often a source of confusion when people call up and we're discussing index universal life. The floor is the floor. So if the market were to decline 3 years in a row like it did back in 2000 during the dot-com crash, your cash value is going to earn 0% for those 3 years. You're not going to earn some guarantee. Where the guarantee comes into play is if you held that policy for 10 years, and almost extremely unlikely, but let's just say the market were down for 10 years in a row, and then you either surrendered the policy or God forbid you died, that's when the insurance company would go back and guarantee a minimum of 2% for those years that you held the policy. Now, mind you, this is not just on the whole, index universal life side. This is true on the whole life as well. Remember, the insurance company is paying whatever they earn in the form of a dividend. They've got a guarantee of 4%. But mind you, that guarantee will likely never ever be paid. Because again, just like the index universal life, it's more of a true up. So that at any point along the way, they can look back and say, here's where you should have been, or here's where we guarantee you will be 10 years out in the future. They can pay anything that they want between the beginning and the end. So I hope that explanation of the guarantees helps your understanding of the life insurance policies. On an index universal life, you buy it before the mechanics of it. There's virtually no human intervention in this. Just like when you buy a portfolio of securities, you don't know what you're going to get. The markets could go up, they could go down, they could go up a little, they could go up a lot. So you don't know what you're going to get. You can look at the market history and say that over the last 30 years, the S&P 500 earned an average annualized rate of return of 9%, for example. I'm just pulling a number out of the air. The same is true with an index universal life. You don't know what you're going to get for a rate of return, but you know how it works. You know that the insurance company is taking the interest that they earn on safe, secure debt instruments, and they're using it to go out to the index options markets to buy as much movement in the market as they can get with the money that they have. So nobody's trying to screw you. Nobody's taking the extra market gains and putting it in their pocket. You're going to capture some return superior to what you would have earned had the interest been just credited to your policy. That's the advantage of an index universal life. All right, lastly, let's talk about some of the IUL myths. I think the most common myth out there is that IULs are going to lapse because the cost of insurance is not guaranteed and it's going to rise. All of the naysayers go around saying that an index universal life is going to lapse because the cost of insurance is going to rise as the insured gets older, causing the policy to run out of cash value. The other myth that you hear a lot is that the charges aren't guaranteed and they can raise them at their whim. So let's talk about how we're going to debunk these myths. The first tool for debunking the myth is common sense. If you find that they're criticizing index universal life and all that they sell is whole life, you might want to question their advice. You want to be able to look at these policies critically with an unbiased eye. So I want to give you the tools that you need without ever talking to an agent to analyze these policies critically and the information that you find online critically. But really, the only tool that we need for debunking these myths is just the basic understanding of how life insurance works. The Life Insurance 101. If you understand how life insurance works, you understand that everything these agents say is a crock of you know what. So let's look back at the chart for a minimally funded life insurance policy. Nowhere on here does it say that this is an IUL or that this is a whole life. But this is how the underlying policy works. The cash value is quite literally the policy owner saving up the death benefit for the insured over the insured's lifetime. That's what happens in all life insurance policies, whole life and index universal life. So the corridor of risk to the insurance company shown by the brackets in this chart is the same for a whole life as it is for an index universal life. They both face rising mortality costs as the insured gets older. But here's what I want you to understand. If we can assume that the cash value in an index universal life is going to grow at a faster rate than the cash value in a whole life, we would find that those brackets shown on this chart would actually be smaller, right? Because the cash value growth would be superior and would be running into the death benefit at an earlier age. So there's actually less risk in an index universal life due to the higher rate of growth on the cash value. No one would ever use a minimally funded life insurance policy for the double play. People that do the double play use maximum overfunded life insurance policies. So let's take a look at a maximum funded whole life policy first. So this graph is showing the cash value and the death benefit for a maximum overfunded whole life policy. And this is for a 45-year-old putting $100,000 of premium into a policy for 10 years. And at the end of the 10 years, we do what's called a reduced paid up, and we lower the death benefit to the minimum non-MEC death benefit. And you can see that the corridor of risk is held to an absolute legal minimum for all of those years beyond the premium paying years, year 10. So that's a whole life. Let's take a look at an index universal life. It's exactly the same. The only thing that's going to be different between these two policies is the growth rate that we assume. Remember, all insurance companies are using the exact same mortality tables. You may have heard that as of January of this year, all the insurance companies had to reprice their products and re-release them under new actuarial tables, mortality tables. This should tell you something. All of the underlying products are all based off of these same mortality tables. So they all have the same cost, they all have the same pooling requirements. So there's your explanation for the second myth, that the policy costs are not guaranteed and that they can be changed over time. The costs are kind of preset at the beginning of the policy because the insurance company knows how much they need to set aside to pay a fixed amount of death benefit years out in the future. They're looking at the present value of the future cost, right? But the other thing to keep in mind is after year 10 of either type of policy, the death benefit is reduced to the minimum non-MEC death benefit. And the cost of insurance is held to an absolute legal minimum. And really the way to look at this is to understand that to stay compliant with the definition of life insurance, some portion of the cash value needs to be spent on death benefit protection. It doesn't say how much death benefit protection, just some amount of the cash value needs to be spent. So it's a fixed percentage. Well, whether the cash value grew at a low rate or the cash value grew at a great rate, the same percentage needs to be spent on death benefit protection. So that's why you see that corridor always, it's shrinking over time, because remember, the death benefit is a client saving up the death benefit over the insured's life expectancy. So if we flip that around and we assume that that premium or the cost is staying the same, then the amount of death benefit purchased is getting smaller over time. Hopefully that makes sense. But you can see it right here in the graph. Understand that the cost here is roughly 1/4% of the cash value is being spent on that death benefit protection in any given year. 1/4%. So whether the cash value earns 4%, you would net 3.75, or if the cash value grew at 10%, you would earn a net of 9.75%. If the mortality costs change, as the whole life people say they will, they're not guaranteed, right? Well, regardless, if some percentage of the cash value has to be spent on that now expensive insurance, it just means that you're getting less insurance. The death benefit is going to be even smaller than what is shown on this graph. Again, this is just common sense. And I want you to have the tools that you need to be able to debunk these myths, because you can see this with your own eyes. Now, getting back to the first myth, that the rising mortality costs are going to cause the policy to lapse. Here, looking at this maximum overfunded policy design, if the cost in that corridor beyond the premium paying years is only 1/4%, you can see that the likelihood of that policy ever lapsing is very, 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 very small. Even if the policy were earning 3%, that's a net of growth on the cash value of 2.75%. And that policy would still perform. It would still maintain a minimum non-MEC death benefit. Now, on a minimally funded policy design, it's a little bit different. Clearly the cost of insurance makes up a much greater percentage of the cash value in those years. But you can see that the year-to-year variation that you would have in an index universal life is going to have a much less impact way out in the future than it would in the early years of the policy. And in the early years of the policy, the cost of insurance is so low anyway that it's not going to impact the policy. So that's all I have for you today. If you'd like some more information and you don't want to talk to a life insurance agent, I highly recommend that you go out to Facebook and look for the Double Play group. This is a group of investors that are using the Double Play to leverage their cash value in their life insurance policies to invest in real estate. And I typically invite most of my prospective clients to go there and talk to people that are doing this to learn for yourself, so that you're not relying on my opinion, my video here to say, oh yeah, this works, because half the videos that you see on YouTube talking about whole life and universal life are wrong. So you don't have to take my word for it. Go out to Facebook, go to the Double Play group, and ask your questions of people who are really doing it. Certainly go down in the description and subscribe to this channel so that you can get notified whenever I come out with new videos. And I've got a now growing and extensive library of videos there, so you can learn all you want to know about life insurance. I've pretty much over the last 13 weeks or so done a complete mind dump of everything I know about life insurance into these videos for your benefit. And lastly, you can go to my website. I consider my website to be a no fluff zone. So I've got tons of valuable content that explain all aspects of life insurance, index universal life, the Double Play, and many different topics that aren't really applicable to the Double Play, but are still valuable for people who are shopping for life insurance.